Myself, Professor P.S. Kamble, Head of the Department of Economics, Shivaji University, Kolhapur, which is one of the reputed universities not in our country but globe as a whole also. And it's a proud and privilege for me to deliver a lecture on a very developed social science, economics in general, and macroeconomics in particular. My today's lecture is exclusively devoted to postgraduate students, and therefore title of my lecture is Macroeconomics for Postgraduate Students or Microeconomic Analysis for PG students. Basically, macroeconomics is one of the approaches looking towards economic analysis, and it is therefore of crucial importance to study macroeconomics by the postgraduate students. Therefore, in my lecture I am trying to discuss some of the issues relating to macroeconomic analysis. Prominently for postgraduate students, macroeconomic analysis is divided into broader 4 units or chapters. Number 1 is national income and national income accounting. Number 2, Keynesian synthesis, new classical and new Keynesian economics. Number 3 is supply of money and demand for money in the post-Keynesian era. Number 4 is theories of inflation and business cycles. Basically, economics being a developed social science, it has 2 perspectives of analysis. One is micro and another is macro. Micro is study of individual or small units, but macro is study of aggregative or large units or of the economy as a whole. The credit of originating the term macroeconomics goes to Ragnar Frisch in 1933. The term macro has been derived from a Greek word macros. Its meaning is large, and thus macroeconomics is a study of large or aggregative factors in the economy or economy as a whole. Macroeconomic analysis is broadly studied under the subheads theory of income, output and employment, theory of prices, theory of economic growth, theory of distribution, money, banking, international trade, public finance, etc. etc. The meaning of the term macroeconomics is of crucial importance for understanding how economy is working, how economic policies are formulated and implemented, problem of general unemployment, performance of the economy, economic growth and monetary problems like inflation, deflation, business cycles, and prominently also consolidated behavior of individual units. Even though macroeconomic analysis is of crucial importance, it has also certain weaknesses, but this is not the place so far as discussing weaknesses of macroeconomic analysis is concerned. Basically, 4 units in which macroeconomic analysis syllabus is divided for postgraduate students. In unit number 1, national income and accounts, the various aspects, concepts, meaning and related terms concerning national income and national income accounting are studied. In Keynesian and post-Keynesian economic analysis, the theories like ISLM model, the theories like labor markets and flexible prices, the rational expectations theory and concept, and new Keynesian economics like sticky nominal prices, Mankiw model, etc. being studied. In supply and demand for money, money concept, money measures, determinants of money supply, how money is supplied in the open economy, these are the various issues which are studied. In the context of demand for money, especially Tobin theory, Baumol theory, Patinkin theory, Friedman theory of demand for money are studied so far as theories of supply of money is concerned. In inflation and business cycles, the concepts of inflation, business cycles types and various approaches of theoretical analysis of inflation and business cycles are being studied. For me, today I am going to give emphasis on a very important unit, that is national income, because each and every country in the world desires to emerge out as one of the most developed economies in the world, and the intention is very clear. They want to emerge out as developed economy and to provide a higher standard of living to the people, because income is an indicator of standard of living of the people. Income is an indicator of growth and development of the economy. It is therefore the national income and associated concepts to national income such as GDP, GNP, per capita income, consumption expenditure. These are the indicators and concepts which are used so as to estimate and indicate standard of living of the people in the society as a whole. In this backdrop, it is of crucial importance to study the number of topics and units those are there in macroeconomic analysis, beginning with national income. I will begin with the concept of national income. Marshall is a well-known macroeconomist and he has tried to define the term national income. According to him, labor and capital, and when they are used along with all productive resources in general and natural resources in particular, produce annually net output of goods and services, in which when we added in the net income from abroad, what we get is known as national income. Along with Marshall, the macroeconomists like A.C. Pigou, like Simon Kuznets, they have also tried to define the concept macroeconomic analysis. To be very simple, they try to define national income in macro perspective, and they come with national income as additions to the goods and services produced during the period of 1 year, deducting depreciation and adding in foreign income from abroad. That gives us what we call it as the concept of national income. When we refer to national income, there are a number of concepts which are associated with the national income, because national income is not a single concept. Number of concepts are very much associated with the national income. To name a few, GDP is there, we call it as a gross domestic product, GNP, gross national product, NDP, net domestic product, GNP, gross national product, net national product, per capita income, consumption expenditure, etc. etc. Basically, GDP is total output of goods and services produced by a country during the period of 1 year. When we add in income from abroad in the GDP of a particular country, what we get is known as GNP or gross national product. From GDP, depreciation on capital assets or goods are deducted. What remains is known as net domestic product. In the gross national product, when depreciation from capital assets is deducted, whatever remains is known as net national product, and it is the net national product which is a concept which is called as national income, or which is referred to as national income. Likewise, when we divide national income by population of that country, we get per capita income. Likewise, private consumption expenditure, private income, personal income, disposable income, these are also various concepts related to national income, and they indicate standard of living of the people as well as the levels and magnitude of development those have been created by a particular country or across the countries in the globe as a whole. The concept of national income is also divided as nominal income and real income. Nominal income means measuring national income at current prices, and nominal income means measuring real income means national income measuring at real prices or constant prices. Even deflator is used to slash impact of inflation on national income. What remains is known as real national income or real national income at constant prices. Basically, national income is generated and it is a flow of income in the economy. Therefore, while studying national income and the related issues relating to national income, it is of crucial importance to know how national income is a circular flow. And this national income is a circular flow can be discussed when that economy is a two-sector economy, when that economy is a three-sector economy, when that economy is a four-sector economy. That circular flow of national income that can be studied, that can be analyzed. It is therefore of crucial importance to discuss and analyze how national income is a circular flow, how national income flows circularly in the economy, and therefore it is known as, it is called as a circular flow of national income. When economy is simple and it is divided into two parts, into two productive sectors only, firms and households. What type of relationship is there between firms and households? That explains how national income is a circular flow in that economy. Households, being an economic institution, supply productive resources to business firms. And by making use of these productive resources, firms undertake production of goods and services. As households supply productive resources in terms of land, labor, capital and organization, business firms make use of these resources and undertake production of goods and services. Business firms pay rewards to the households in the form of wages, rents, interest and profit, and thus households supply productive resources. In return, business firms supply rent, wages, interest and profit. Thus, income is generated and it is circulated in the economy, and this is what a two-sector economy, and the income is circulated in a circular manner. When economy is a three-sector economy, in three-sector economy is divided into three productive sectors, and these three productive sectors are basically government, households and firms. When households supply productive resources to firms or business firms make use of these productive resources and undertake production of goods and services. The goods and services, when sold, rent, wages, interest and profit are paid by the firms to the households, and thus there is a flow of income from households, from firms to the households. Government is a supreme authority, therefore it imposes taxes on both the households as well as firms, and in return that tax is collected and tax revenue is spent by the government for payment of salaries and wages to the employees provided by the households and payment of the goods and services supplied by the firms. And in this way, when the economy has three sectors, the flow of income is circulated from households, from firms to the government and across these sectors also. And in this way, a circular flow of income that takes place, it is known as a circular flow of income in a three-sector economy. In four-sector economy is divided into four sectors: household sector, government sector, business or firm sector, and foreign sector or foreign countries. First of all, households supply productive resources, land, labor, capital, organization to firms. Firms undertake production of goods and services by making use of these productive resources. Government imposes taxes and collects revenue from households and business firms, but at the same time, business firms get revenue in the form of purchase of goods and services by the government. And households get income from government as salaries and wages for supply of the labor and employees. Now, foreign sector is there. Households also supply human resources to the foreign countries, and in return they get salaries and wages. Business firms also export goods and services, and in return they get export value. Also they import goods and services, for that they pay import value. In this way, money is circulated across the productive sectors: households, governments, business firms and foreign countries to households, and thus a circular flow of national income takes place. Now, why it is necessary to study circular flow of national income? Because that understands disequilibrium in the economy that is there, what leakages and inflows are there in the economy, what type of relationship is there between producers and consumers, how network is there across the different markets, how multiplier works in the economy. All these we understand. It is because of understanding of the circular flow of income, and therefore circular flow of income is necessary to be studied. In national income is measured by making use of three methods: production method, income method, and expenditure method. Value added method is a part of production method, but how productive resources are used and how production is undertaken, that is only studied. But what type of relationships are there between the different productive sectors, that is not being studied by studying of national income and measurement of national income. And therefore national income accounting is studied, which is also known as social accounting. It is also called as social accounting of the national income. In social accounting, basically attempts are made to study with the help of statistics and statistical data interrelationship between the different productive sectors in the economy. Agriculture can be there, industry can be there, service can be there, and different sub-sectors can be there. And when those are taken into account, how the relationships are there, those relationships are being studied. For example, in social accounting, all economic activities are divided into production activity, consumption activity, capital activity, government transactions activity, and external or rest of the world activity. And in these productive sectors, how the transactions and relationships are there, those are being studied, and those are studying in two parts: payment side and receipt side. What are the items of payments and what are the sources of receipts? Those are taken into account for all the productive activities in the economy: production, consumption, then capital accumulation, as well as government and rest of the world, that is external sector. Basically, social accounting is presented in terms of matrix, which is called as a matrix of social accounts, in which two sides are there. One is receipt side and another is payment side. In receipt side, all productive sectors are taken into account. On payment side also, all sectors, namely production, consumption, government, capital, are taken into account. And the what receipts are being provided and what expenditure is being incurred by them, that is presented in terms of statistics, that is presented in terms of statistical data. And that gives us a scenario about how the relationships are there between the different productive sectors and across the productive sectors also. In national income accounting, a very important aspect which is necessary to be studied, and that is input-output accounting. Because there is an input-output relationship between the production process and production activities. For any productive activity and for production of any commodity or service, input, that is resources, are required, and when those are converted into a commodity or service, we call it as an output. Therefore, input-output relationship is necessary to be studied, and it is studied in input-output accounting. In input-output accounting, table is prepared which is known as input-output table, and that input-output table has two sides. One is credit side and another is debit side, which is also known as input side, and another is output side. What inputs are provided by different productive sectors to a particular productive sector, and what output is produced and it is supplied by that particular productive sector to different productive sectors, that is being studied. For example, agriculture, manufacturing, others, they are on the one hand, and on the other, agriculture, manufacturing, imports, primary inputs are on the other hand, and how they supply inputs to each other and how output is produced, and the produced output is how distributed among the different productive sectors, that is studied under the input-output accounting. Then after input-output accounting, it is of crucial importance to know what we call it as a flow of funds account. In flow of funds account, for any productive activity, finance is required, financial capital is required, and in absence of funds, no productive activity started and no single production of a commodity or service is possible. And it is therefore how the flow of funds takes place for different productive sectors in the economy, which are used in the productive activities, and consequently production takes place, national income is generated. Prominently, what are the sources of funds and what are the heads of expenditure? Those are studied under the title Flow of Funds Accounts Matrix. Basically, the categories like gross saving, gross investment, financial uses, financial sources, government securities, corporate securities are taken into account. And on the other hand, productive sectors like households, non-financial corporation, financial institution, governments are taken into account. And how money is raised or fund is raised and how fund is used, that is being presented in the form of statistical data, statistical information, and that gives us what we call it as a flow of funds matrix or flow of funds account. In national income study, there is also need for balance of payments study, and therefore balance of payments is studied under the title balance of payments account. In balance of payments account, basically it is a international trade related aspect, and it is accounting. Export and import is being studied, and how the balance of a particular country's balance of payments is maintained, whether it is in equilibrium or disequilibrium, that is presented. Balance of payment is basically divided into two parts, current account and capital account, and one more account is there, that is official settlement account. In this current account, trade account is there, service accounting is there, and how export commodities and services are exported and commodities and services are imported, those are presented in the form of credit or receipts and debit or payments. And in this way, what transactions are being carried out between these productive sectors, and whether it is in equilibrium, disequilibrium, deficit, etc. being attempted to study. And this gives us balance of payments accounting. To conclude my lecture, national income has a number of issues and aspects, and it is of crucial importance to study. Therefore, it is necessary to be studied. And it is of also crucial importance to look at national income in the perspective of the impact of external sector, especially export and import, on the growth and development of the economy. When we say national income is an indicator of growth or development of the economy, it is of vital importance to study how external sector in general and international trade in particular influences national income generation in the economy, and thereby its contribution to the growth and development of the economy as well. When balance of payments accounting was taken into consideration, it is found that export and imports are being carried out, and both have impacts on income generation in the economy and consequently growth and development of the economy as a whole. In balance of payments accounting, basically receipts from foreign sector and payments for foreign sector are taken into account, and these receipts and payments from foreign sector create either surplus or deficit in the balance of payments. And surplus or deficit in the balance of payments is an indicator of whether a rise in income has taken place or a fall in income has taken place. When receipts from foreign sector are greater than the payments for foreign sector, that balance of payments is in surplus. And surplus means it is contribution to the increase in national income of that economy. Because whatever extra income that is generated, it is not being spent on the foreign sector, but it contributes to the national income of that economy. And it is therefore export and import, receipts payments of the external sector, foreign sector, those are of crucial importance while studying national income in general and balance of payments accounting in particular. And from the position of balance of payments accounting, we are in a position to understand how that contributes. What is the linkage of contributing external sector, international trade to the national income generation and consequently growth and development of that economy. Basically, exports and imports are taken into account, and from receipts from foreign countries and payments to the foreign countries are taken into account. That gives us an idea that receipts are greater than payment means surplus in balance of payments, and surplus in balance of payments mean income level increases in that economy. But foreign payments are greater than the foreign receipts means there is a fall in the level of income and outflow of income from that country to the foreign country. And therefore, when balance of payments account is taken into account, that can be divided into consumption expenditure, saving and taxes collected by the government on one hand, and on the other hand consumption expenditure, investment expenditure, government expenditure and net export value. When the calculations are made, that gives us consumption expenditure, saving and taxes collected by the government, and when in that export value, net export value is added in, that gives us what we call it as a addition to the national income and consequently growth and development of the economy. This balance of payments disequilibrium, we call it as a deficit or surplus, is basically measured in the form of three parts. Number one is basic balance, number two is net liquidity balance, number three is official settlement balance. In basic balance, current account balance and long term capital account balance is taken into consideration. In net liquidity balance, basic balance plus short term private non-liquid capital balance, allocation of special drawing rights and errors and omissions are taken into account. In official settlement balance, total net liquid balance and short term private liquid capital balance are taken into consideration, and when all these three accounts are taken in totality, whether the payments are greater than the receipts or receipts are greater than the payments, that shows the state or position of balance of payments of a particular country. When payments are greater than receipts, that balance is in surplus. When total debits are greater than total credits, that balance of payments is in deficit. And basically, it is presented with the help of statistical information also. Trade balance, current account balance, basic balance, all these are taken into account and they are known as autonomous items of balance of payments. On the contrary, errors and omissions, net liquidity balance, those are known as accommodating items. This gives us a picture of whether a particular country is in surplus or deficit so far as balance of payments is concerned. When it is in deficit means that trade account is in deficit, service account is in deficit, current account is deficit, and the government has to introduce and measure such policies and remedies which are helpful for the economy. As the result of that, deficit in the balance of payments can be controlled, it can be restricted. Because so as to exploit and utilize international trade as an engine of economic growth, export and import as an engine of economic growth, more concentration should be given by that country on promotion of exports and controlling of the imports. Yes, imports are necessary, but we have a particular policy. That policy should concentrate on importing only capital goods, importing only technology, importing only capital assets which are not being produced in our country. Those are helpful for us in the growth and development of the economy, development of agriculture, development of industry, development of service sector. Especially the imports are necessary for the developing countries like India, in which to the greater extent possible, those capital goods, machines, tools and equipments, technology and science and development that is not there, that should be imported from the foreign countries, from the developed countries. But the capital goods which are being produced in the economy should not be imported. Prominently consumable goods, consumer goods should not be imported from the foreign countries, because that doesn't contribute for the growth and development of the economy. It is therefore we should very seriously think of balance of payment accounting, because that indicates before us, that shows how international trade is working as an engine of growth, or it is adversely affecting so far as growth and development of the economy as a whole. If we want to utilize and exploit engine of economic growth from the international trade or foreign trade, we should try to promote exports. Import we can import, but import should be specific. Import should be peculiar. Import should be particular. As the result of that, those will not adversely affect so far as growth and development of the economy. And thus, international trade in general, balance of payments accounting in particular, and export scenario of that particular country shows how that external sector is working, how it is generating income in the economy, how inflow of the income is taking place in the economy, and consequently promoting levels of income, consequently growth and development of the economy, and consequently raising the standard of living of the people. Thus, even though external sector or foreign sector is of crucial importance, it should not be segregated from national income accounting. Therefore, it is a part and parcel of national income study exclusively and national income accounting particularly, and therefore balance of payments and balance of payments accounting, its part and its parcel should be studied elaborately in detail. That is what expected so far as the topic of national income and national income accounting is concerned. These are very important issues, must be covered under the title national income and accounting of the national income, so far as macroeconomic analysis study for the postgraduate students of any university is to be